Trump, if he was in power, would be getting straight on X and, trying to talk down the price, saying they've spoken to the Saudis, saying they need to, going back to that with going to sue OPEC and things like that they've said before. We might be going back to like SPR releases out of oil, but we've already released a hell of a lot. So I don't know. What do you think they do?
Maybe the Fed would have to talk about having to do another hike.
Hi everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive on Onyx Capital Group, joined today for another market episode with Vincent and James Brody. So I just want to make a quick thank you because we've hit the 1,000 subscribers we were excited about. It really makes a big difference to us. And please remember to like and subscribe if you haven't already. So, all right, getting straight into it then, Vincent. What's been happening in the last week?
So on today, about the flat price, crude flat price has been remarkably neutral and range bound over the past week, sitting comfortably at around $82.
Remarkably neutral.
Remarkably.
Okay.
Remarkably, compared to what we have seen over the past 2 years. The last few weeks, there's just not been much headlines, not much movers in the market. Supply and demand is really in equilibrium. Price is sitting very comfortably at the low 80s levels, which market participants seem happy to be at. Technical indicators are very neutral, low volatility, RSI sitting around 50. And more of the action is really happening in the niche oil futures markets and dated Brent and Dubai crude. Something interesting to mention is that recently money manager positions in WTI futures in terms of their short positions have been reducing by a lot over the last few weeks. Shorts have closed 60 million barrels of positions, 4 consecutive weeks of decline, and that indicates short covering flows in WTI as WTI Brent spreads correct higher. So over the last few weeks, it's been rallying from around minus 4.7 to minus $4 per barrel in the prompt. So it's just been, market has just been adjusting to this newfound equilibrium in the main flat price.
Yeah. So I think it's easy to do this kind of like generic analysis, and we want to make sure that we're also caveating with A, our views, B, our what we think is actually going on. So it might have been neutral, and we were bullish crude, bullish volatility, talking about how it could get into that zone of being dangerous. So I think the big news is that we got a really dramatic sell-off in the dated Brent markets, having been so high in some of these differentials, the physical looking so strong. So what happened? Well, you can't ever really know exactly why things happened, but it coincided with a very strong sell-off in the Brent spreads post-expiry. So the Brent time spread's good indication of the underlying physical, sometimes definitely into expiry, but up to that point, it's at the mercy of financial flows, as we keep going on about. So this time round, it was very susceptible to selling flows, and I think the market getting overexcited overly long, that danger zone we were talking about was instantaneous. Yeah, there's a hell of a lot of money under management in WTI, in Brent futures via ETFs, right? You've got USO, which is multi-billions under management. You've got Wisdom Tree. I think there's the two main ones, but there's loads. There's Goldman Sachs Index. There's I think Bloomberg, Barclays have some, and so there's a lot of ETFs, funds and exchange traded products that its job is to track these indexes. So what you end up with is a very, very large pool of liquidity that needs to be rolled to the next month, which they tend to do at the beginning of the month. So I think all are transparent about it, but it's quite hard to get all the information in one place. But it's roughly the first, from the 5th working day, we tend to see quite a lot of rolling. So almost, on the nose, as soon as the selling came in, it just looked like there was no buyers, which would make sense because everyone's long, everyone's getting very excited about it, like us. Then you get the index roll selling, which again, you always say to yourself, but we know this happens. How did we not think of this? It happens every single time. So that's why systematic thinking is always going to be better. But anyway, we had a lot of roll selling, and the spreads just got smacked all the way down. I think the front spread something like 90 down to I think 45 the lows recently, and that coincided with just generally a really bearish sentiment in a way. but only because the market was moving. Now this morning you get a retracement from the lows. It's suddenly starting to gap up on no volume, and meanwhile all this was going on, Brent futures didn't move, and now they're rallying back up to 83. That is a very bullish sign for me, basically because it was able to take all this selling flow, momentum bearish on the underlying, and still hold firm. So I think without that selling flow, at least in the underlying, we should start to perform now, could start to perform now, absence of the index flow. It's only one signal, but it's worth pointing out. And I think when we say things are neutral, sometimes they're neutral because nothing's going on, but other times they're neutral because there's counteracting flows. So I think it's the latter, and I think it could still be very interesting, and I think it's still a really interesting next couple of weeks. So when you look at the underlying physical crude, and it is all very strong. The only thing that's changed is probably the localized strength that people are getting excited about has now moved from dated Brent and Europe, Western style demand, to Eastern again. Dubai is in focus again. Brent Dubai is back to negative. I'm sure you're about to talk about that. Were you?
Yeah. Yes.
Yeah. Yes. Basically people are getting excited about crude, but now in the East. But either way, it's a macro kind of bullish sentiment, I think, still holds. Vincent, on that Brent Dubai, do you want to talk a bit about that then?
Yeah, so Brent Dubai recently went into the negative handles once again. So that's in the prompt tenors, and boxes moved into deeper contango as well. So on the fundamental reasoning, it's on the back of stronger demand sentiment, especially for Middle Eastern crude grades. You had OPEC cuts being extended into Q2. Arab light OSP to Asia customers increased for April, surprising some market participants, especially with the fact that for Aramco, they've full term volumes have been allocated to its Asian customers, and it's been heard that supply of heavier grades have been reduced, with one Chinese buyer requesting to lift more Arab medium and heavy crude, but their request wasn't met. And Brent Dubai had been range bound over the past month, over February, around 30 to 60 cents, low volatility, and all of a sudden it rallied and then dropped off massively, as you see in the charts. So almost like a dollar drop. So heightened volatility, a lot of perhaps existing length being flushed out.
Yeah. I think this is all very indicative of like almost a return back to the first half of 2023, where it was a Dubai-led, Eastern crude-led rally on the back of the OPEC situation. So it's coming back into focus. Now, what is the big theme this year, both on the downside, upside? Downside, China, lack of demand. James has talked a lot about the economy being very weak. We kind of felt there was getting to the point where every bearish headline out there, at some point, it's not about it being bullish, it's about it being less bearish for there to be a rally. Now, it took a couple of weeks after the Chinese New Year, but this week in particular, after all this kind of weakness in Asia, there are signs that China in particular, but Asian demand for oil at least, is coming back with a vengeance. So I would start with the Dubai. As you say, big clearing out, selling. Saudis are so comfortable with their selling volumes into China that they're actually raising the OSP to Asia. That's a great indication that they're starting to buy, starting to absorb. The propane markets and the Naphtha markets have seen Chinese buying quite a bit in the last few days. Big rallies in the petrochemical complex and light end complex. That is a very China-led market in Asia. So look, we don't have hard evidence for it right now, but I'm sure the forward data will indicate that demand has come back for oil. I don't know if it'll be fleeting or not, but you can see it filtering into all these contracts, which I think now the next thing for it to filter into is probably Brent. So we'll have to see on that basis. But I think that's probably a good time to talk about macro, James. So again, going off what Vincent said about it being neutral, but then we're kind of caveating that with some pretty decently bullish signals. How does that play out against the macro situation right now?
Well, right now there's three key topics that the market's focusing on. Firstly, the data in the US in the last week came out better than expected. The economy remains resilient. The employment data, the headline was strong, but the unemployment rate jumped from 3.7 to 3.9%. That's still a strong economy. And we had CPI yesterday. This is not really a concern for the Fed, but it's something they'll take notice of, is CPI is becoming sticky at 3.2% year on year. It's not falling lower towards target. On the other hand, in Europe, the data continues to be weak, particularly in Germany. We've also had weak data out of England, UK. Yesterday, employment data was very weak. Today, industrial production's weak. So the overnight index swaps, what the market's pricing is similar cuts this year, 84 basis points from the Fed and 97 from the ECB this year. If anything, we should see the market pricing more urgency from the Bank of England and the ECB. They need to hike more aggressively and sooner. That would weaken the euro, that would weaken the pound, and that would be strong for the dollar.
So unexpected rate rises would be hugely impactful on people's sentiment. Is that fair to say, in equity markets in particular, but probably macro-wide?
Yeah, I don't think we don't see rate rises, but what we're seeing is the market's continually to price out the cuts that had been priced in.
Yeah, so forward is in higher than what they're predicted to be.
Yeah.
But at the same time, higher than expected inflation, it seems to be very sensitive to energy prices. And we're all calling for a rally here. I think the market in general is calling for that. I think the signals are there for that. So, $90 Brent is going to be roughly $120 kind of gasoline, key products like that. That's getting into demand destruction, inflation-inducing highs, as we've discussed, or at least that's what the level roughly correlates with the pain in the market, if you like. So energy-adjusted inflation, I mean, do you have a view on that? I mean, absence of energy, would we still be getting inflation rises?
Absence of energy wouldn't. We're seeing rent continue to come low. We see second-hand car prices come low. We keep seeing the other anecdotal evidence of that coming lower. But if we did see it tick up on the back of energy prices, then that would spook the markets. The Fed would have to take notice. And the second point I was going to come to is that there's a lot of complacency in asset markets. The S&P's back at all-time highs, gold's at all-time highs, Bitcoin's at all-time highs. The Nasdaq's just off all-time highs. There's been more volatility, but the asset prices are very confident at the moment.
So I think when we talked last week about this danger zone, everything tells me that we're very much in that already, and people should be expecting volatility. I also saw something interesting about people piling into an ETF that shorts volatility, shorts the VIX, and that feels like a very dangerous trade right now.
If you remember back to the risk parity trading, I think it was 2018, 2019, we had the huge dump. It fell something like 85% in 20 minutes. Again, shorting volatility, that is hugely risky.
Yeah, it's in from what we're seeing. Bubbles, like you're saying, people like nonsensical rallies and some things. And now we're taking, the only thing we can take a look at with a degree of expertise, the oil markets. So what position are we in? Let's fast forward 3-4 weeks, where, argument's sake, we're a good 10 to 15% higher in energy prices. That should filter in at least a couple percent into the inflation, especially if it's so sensitive at the moment. What do governments start? I mean, what starts happening? Do people start reacting to that like for like in their macro portfolios? Does, as you say, the Fed take notice? Do they have to? What happens? Or do we go back to this US style thing, which is Trump, if he was in power, be getting straight on X and trying to talk down the price, saying they've spoken to the Saudis, saying they need to, going back to that, we're going to sue OPEC and things like that they've said before. That's probably more likely to begin with, although Biden doesn't seem to have the same kind of aggressive rhetoric publicly. So I doubt it's his thing to really try and talk back down markets or back down oil. So if he's not going to do that, then actually there's nothing really stopping. We might be going back to like SPR releases out of oil, but we've already released a hell of a lot. So I don't know. What do you think they do in that scenario?
The first thing is bond yields rise,
yeah,
and the Fed have to take notice of that, which you'd see bond prices falling as yields go up. You'd see asset managers selling the bonds. You'd definitely see the markets,
they're more
equity
printing
markets,
again,
start to start to get nervous, and then maybe the Fed would have to talk about having to do another hike.
Yeah, I mean, it's like pretty worrying.
And then the complacency would be taken out of asset prices very, very quickly.
Okay.
Yeah, equity markets would find that very difficult. That would be the worst case scenario for equities.
Okay.
The other key point, actually, while we're on the macro, is next week we have the Bank of Japan. Negative rates, several years, minus 10 basis points. The last key for them was union wage growth. That's coming through this week. At the moment, I think first 60 unions, the average wage growth is 5.43%, which is way above expectations. So the market now expects the Bank of Japan to hike next week on the 19th. So that could start to have an impact. There's also talk they may end yield curve control. Again, as you see yields rise in Japan, you could see flows back in Japan. There's the biggest offshore owner of US equities is Japan. And again, that could be another signal for US bond selling, yields higher, which again puts more stress on equities.
So just so I understand though, that it is slightly different for Japan because they've been negative for so long. A rate hike demonstrates a positive view on their economy. It's actually quite bullish. It's
good for the economy. It's fairly bullish. And actually, the Nikkei's just broken its 34-year peak.
But you're saying because they hold so much foreign assets, they'll start to sell foreign and buy their own.
Exactly. Money will start to flow back onshore.
Okay. Yeah.
And again, we'll see yen strength. And these are a couple of trades we highlighted in January: yen strength and gold breaking higher.
I think it's a pretty clear case then, at least from an energy perspective, and what you're saying. It's basically west to east. There's eastern strength, possibly. If we could do a spread with macro and oil, it would be buying east, selling west, essentially. That's fair to say, I would say.
And real weakness in Europe.
Yeah, selling west.
Yeah.
Cool. So Googling oil then, the main headlines. I guess James mentioned a few there, gold making all-time highs, things like that. But from the oil perspective, Vincent.
Yes. From oil perspective, on Tuesday there was a renewed round of attacks from Ukrainian drones targeting Russian energy infrastructure, so causing explosions and fires at fuel refineries. For example, one of the targets was the Lukoil's North Sea oil refinery, a few hundred kilometers from the Ukrainian border, in which its main crude distillation unit was damaged. So Russia's Ministry of Defense says Ukraine had launched at least 25 drones and 7 missiles. So there's, what are the implications? Of course, the timing is quite significant because Russia has its presidential election being held this weekend, which we all know what the outcome is likely to be, but it's also an attempt to improve the morale on the Ukrainian side, because there's talks that there will be further conscription of looking for 500k new recruits, as well as Ukraine losing out on the battlefield in recent months as well. So by that, it's a type of warfare there, because Russia's has been targeting Ukrainian infrastructure. It's kind of like a tit-for-tat move, especially considering recent timings and events.
Yeah, this is interesting because we've talked about these strikes a few times over the last few weeks. I think it is time to start taking notice, because although we were taking the view that it won't have a global impact on oil necessarily, but it might have immediate impact, but it might have a steady impact because of the refineries being hit means basically less product getting into the export pool, starting to tighten the market in a market that's already looking quite tight. So this is a level up because it's hitting the biggest refinery or one of the biggest refineries in Russia, basically. And it being to the Europe side, European refiners are in maintenance right now, or coming up to. There's already refinery fires left, right and centre, refinery outages in the world. As Eastern demand comes back, and as this now starts to become more and more serious, I genuinely think this is a market driver we can't ignore. And it's this weird thing, because we're looking at markets from like a Western perspective, Western media, Western trade views and exchanges. It's almost like you go, well, Russia aren't a part of the oil market anymore, in a weird way, you're thinking, because they don't, their export channels have changed and things like that. You just absolutely cannot ignore it's still producing everything it was producing before, or not. So basically its impact of not producing products from its refineries is still just as big of an impact as it was pre-invasion. So I think that would be a mistake for people to not, tie this into their supply and demand, of course. So this could be very interesting. So right, what else on the Google oil?
There's another one, OPEC IEA at most divided on oil demand since at least 2008. So these two agencies have the world's most closely watched forecasts of oil demand growth, and their divergent signals. They're having divergent signals on in terms of the speed of the world's energy transition. For example, IEA was predicting 1.22 million barrels per day of demand growth this year, whereas OPEC is predicting 2.25. It's interesting because IEA is predicting oil demand to peak by 2030, representing their renewables and being pro-renewables and climate action, whereas in OPEC's forecasts, even up to 2045, they do not predict oil demand to peak. So it's actually interesting because it shows two sides of the argument. On one side, you have for OPEC, the Saudi energy minister was mentioning that for the IEA, the sort of stuff undermines their role as an impartial authority. But on the other hand, OPEC members also rely on fossil fuel revenue.
So they're not impartial either.
Yeah. Exactly.
So take the middle, and it looks like you're saying most research houses have done that.
Middle ground, at least closer to the IEAs actually. So, but then IEA is more on the lower side because they tend to revise their demand upwards, and having done so for this year's forecast already 3 times.
I think my personal view is the demand side it's a bit of a fool's errand to try and predict demand. You've got a much more likely, higher probability chance of predicting supply, and then you can look at how the physical premiums are playing out to kind of gauge demand. And I think what we've just been saying about inflation and just what's around the corner, you've got to include how the demand changes as the price rises. So if we're already starting to noticeably increase inflation where we are right now, and demand is strong enough to outstrip the supply that's on the market right now, I think that's pretty fair to assume because of where we know OPEC are. We know stocks are drawing, we know crude's tight with the current supply, and we know that's going to be unchanged throughout as we go on more into a demand area like Q3. So it'll be a mistake to assume that it's a orderly rise in demand just because that's general, the macro economy is improving. Like things are going to be very variable basis inflation, of course, and it's where that demand's coming from and all the rest of it. So I think not that we can ignore it, but it's much more interesting about supply against stock draws, physical premiums, and kind of where that's trending. So we'd have to say demand is at least strong enough right now to cause a bit of a worry because we know we're not going to get more supply. We know there's refinery outages, but the market's already kind of positioned towards that, right? The market already is pricing in product over crude being very strong throughout the year, and all this does is the current environment just suggests that this is going to maintain. But that all changes as soon as flat price rallies is what I'm trying to say. So demand forecasts just, I don't know, they don't do it for me, but I guess you just got to have a finger in the air. But in terms of their divide, that's Taylor's oldest time. I mean, it might be the most since 2008, but it's what you're going to get when you're going to get someone factoring in more the Western thinking and where we want to go with renewables versus someone who's that's just obvious, right? So not huge headlines for me, but I guess a bit of clickbait for people. And anything else?
We have another one. Rising Guyanese crude exports weigh on Norway's Sverdrup in Europe. So just talking about increased Guyanese crude exports hitting record high of over 400,000 barrels per day. That's been, the loadings of the Guyanese crude have been Europe bound, adding pressure on the Johan Sverdrup grade in the North Sea, in which its values are at a 14-month low, because the two crude grades are very similar in quality and therefore a substitute grade for European refiners.
No, that's interesting. I think the only thing to note there is when you say 40-month low, you mean that as a differential, I'm assuming, the physical differential.
Yes.
And that physical differential, if dated, is very high, which at least it was in the prompt. The higher that gets, the more the differential outside of the dated Brent markets have to kind of compensate. You get a natural weakening of physical differentials the stronger the benchmark gets and dated. So it's not huge. I don't think that's. I mean, yeah, I see your point. There's more competition, but ultimately, yeah, sometimes it's just about you got to. What is the physical differential a benchmark to, or benchmarking against? And if that's strong, you see what I'm getting at, right?
Yeah, that's against data a bit more on the.
Yeah, you see it with CPC differentials as well. Like they tend to weaken when you get this strong dated strength. Yeah. Cool. So, trade ideas.
Trade idea this week, I was thinking about suggesting the long April-May Brent to buy box as a contrarian trade, looking for a mean reversion. Of course, we had Dubai crude complex seeing very bullish sentiment recently on the back of stronger fundamentals, as well as a lot of shorts entering across down the Brent to buy forward curve, and we think at current levels, market might have been a bit overextended towards the short side if in the money shorts take profit, if going into the next month's loading cycle sentiment weakens again, then we could see a large correction upwards, especially now that it's price action has broken out of the previous ranges, so we can expect higher volatility both to the downside and potentially to the upside as well. The key thing is to have a very tight stop loss at these levels, April, May around minus 30 cents per barrel, in case further stop outs invalidate our hypothesis. So just
this is more of it's overextended trying to, I mean, it seems obvious you want to buy obviously what was perceived as cheap, and it looks cheap because there's been basically a big sell-off in the boxes, but it is logical, right? The box sell-off has come with like genuine Dubai strength, the Chinese demand we've seen, you know what I mean? So you're fighting a trend fundamentally here as well as directionally, as well as technically. So it's definitely a higher risk trade, I would say, unless you just believe that, April, May Brent Dubai box, not to get overly technical here, but that's April Brent swap, so that's really a June, July Brent spread position against the prompt Dubai. And yeah, June, July could very well be on its lows because of all the index rolling I was saying before, and long-term looking bullish. So yeah, it could be, but I think there's better expressions if you're bullish Brent than this, but it's not about who's right or wrong. It's an idea, right? So I'm not trying to shit on it, but I think what we also should do is, these are niche trade ideas, but we want to get into the habit more of like, okay, what are some of the more macro trades? I think, as I said, we've been bullish Brent. We've seen this reduction in volatility. We said last week volatility could be a buy. I think I'm just going to say it again. You would have lost money following my idea if I said that last week. But it does all give that indication. I think outright, the flies look quite cheap in Brent. The WTI's come off a lot. I wouldn't really want to touch WTI, being so susceptible to freight and things like that. So I think it's just looking kind of macro bullish. I would avoid the products because of what we've talked about before. There's probably still some room left on the momentum side for Eastern products, like the East-West that have been so low. Asian versus Western contracts are kind of generally, I think, looking attractive. And anything from a macro basis for you, James?
I think gold continues to move higher. We're seeing more and more hot money flows into that. It's getting more and more headline attention. I think the dollar as well over the next weeks and months will strengthen because the economy is just much stronger. We're just seeing a lot of weakness, not just from Europe and the UK, but also Australia and New Zealand economies are looking weaker.
So maybe even buy the VIX. Buying
volatility. We saw a huge move on Friday actually in the AI stocks, a huge outside reversal in Nvidia. It had a sell-off again Monday, Tuesday it bounced back. But again, one big day doesn't make a trend, but it's interesting to see how this week plays out from the volatility perspective there.
Okay, great stuff.
And also Bank of Japan and the yen, but that becomes a binary outcome whether they hike or not.
Yeah, okay. So we put on a poll on LinkedIn, what GDP do you think China will hit? They came out last week saying they're going to achieve 3.5% growth. 5% growth. And we said, what's more likely? Will it hit that roundabout, lower than 3.5 or over 5? And actually, most people thought, yeah, they're all thereabouts, I guess, which is probably not unsurprising. A bit of a cop out, but I think maybe at least our view or my view has changed a bit since last week because of the indications we're getting from the Chinese in the oil market. At least it might not be the indication, but it does kind of seem it's going that way. Okay, so we'll leave it there. Thank you, Vincent and James. And again, thanks again for the subscribers. And again, please like and subscribe if you haven't already. We'll be joined the next episode in another episode of our leadership series, where we'll be with Jasper Bird, who is a king Naphtha trader in Onyx. And that should be a very interesting podcast if you have the time. So thanks again, and see you soon.